Welcome back. First panel discussion is on new paradigm in banking. We have a gallery of very distinguished speakers with us. I'll first introduce the speakers, and then I'll give a short theme presentation on the topic. We from IIBF had written to all the banks requesting their views on various areas. We have received responses from them, so we thought that it is better to consolidate those responses so that what is the industry view that will be available to the viewers. Mr. Arun Tiwari is the Chairman and Managing Director of Union Bank of India since December 26th, 2013. Before joining Union Bank of India, Sri Tiwari was Executive Director in Allahabad Bank from June 18, 2012, and handled portfolios of credit monitoring, HR, IT, risk management, finance, accounts, vigilance, branch expansion, and support services. He has also served as director on the board of Allahabad Bank Finance Limited. Mr. Tyrone Chen is currently the Executive Vice President of Taiwan Academy of Banking and Finance. He is also the Secretary General, Financial Planning Association of Taiwan, and the Independent Director of Mega Bank. Mr. Rajnish Kumar assumed charge as Managing Director, Compliance and Risk of State Bank of India on 26th May 2015. Prior to this, Sri Rajnish Kumar was the Managing Director and Chief Executive Officer of SBI Capital Markets Limited, the merchant banking arm of State Bank of India. He also headed the project finance vertical as Chief General Manager, and he was also Chief General Manager of Northeast Circle, which controls 7 states of Northeast. And prior to that, he was head of UK operation of State Bank of India. Mr. Saurabh Tripathi is a partner and director of Boston Consultancy Group. He heads the banking practice of BCG in India. Saurabh holds a BTech in Electrical Engineering from IIT Kanpur and an MBA from IIM Calcutta. He was awarded gold medals at both institutions. He was adjudged one of the India's 40 top young leaders by the Economic Times in 2014. So we are privileged to have a very distinguished panel in this discussion. As mentioned in the inaugural session, banking is changing. Change is reality, and we are living in the changed world. So how we are going to cope with this changing environment, that is the challenge before us. We have listed some of the areas. Banking essentially had moved from brick and mortar to click and order in e-banking. Physical check clearance has become obsolete. We have gone into electronic clearance system. There are many other areas where banks, the way we are doing banking has undergone a sea change. So how we cope with this change, how we position ourselves with this change, that is a point to be discussed, and we should be aware and we should be prepared to handle that change. There are diversified reasons for shift in this paradigm. Customer expectation has increased. Technological advancement has provided a fillip in the entire system. And the way we used to deliver has undergone a sea change. So we need to see how our deliveries should be sharpened, focused, and how this will have to be done in days to come. Stricter regulatory norms have come into existence. There are a lot of security concerns because of a lot of IT intervention which is there in the banking system. And risk magnification is another area which all the bankers need to handle. So future focus areas we have listed in this slide is known to all of you. First and foremost is compliance and risk management, growth, how to leverage digital technologies, how we will collaborate, and how other financial intermediaries will act. Payment transformation, how is going to happen. Data management area, there's a lot many changes. Big data, data analytics has become prominent, and bankers will have to take full advantage of these tools which are available with us. So here in this slide, we had tried to capture the focus areas in this particular area of discussion. Challenges ahead, because any change will have associated with the challenges. Challenges will be there, but it is up to us how to handle those challenges. As I told you earlier, we have written to the banks and we have got some feedback that how they are positioning themselves and what are the thought process which is going on in different banks. And these have been summarized in this particular slide. Like product innovation has assumed a lot of importance. Business process reengineering had been introduced. Robust onboarding program for new recruits, that is also assumed importance. Data analytics is a focused area for all the banks, and more and more banks are taking advantage of this. Investment in online marketing, and so on and so forth. So we have tried to summarize the steps taken by different banks and what are their suggestions to handle this new environment which they are facing. So without taking much time, we would like to flag some of the discussion points for this eminent panel to discuss, but these are only suggestive. It is all open, and when such a distinguished panel members are there, they have come with rich experience and knowledge. I think that many more points will come out of this discussion, and I'm sure that it will be a very informative and lively discussion. So with that, I would like to make the floor open to the panelists. Mr. Arun Tiwari, CMD Union Bank, he will be moderating the discussion. Sir, over to you, sir.
Thank you, Dr. Misra. First of all, welcome you all participants here for this very interesting panel discussion, New Paradigm in Banking. And I must compliment APABI and the host here, IIBF, both for choosing very contemporary and very relevant topic for panel discussion. And when I talk about the panel, this panel has got quite interesting composition. Mr. Chen, he is Executive Vice President and he brings in the international perspective for the discussion. Rajnish Kumar, a thorough, hardcore banker, and then we have Mr. Saurabh Tripathi, who will have always a perspective outside studying the banking system, for the banking system. Of late, we have been talking about consolidation, but at the same time in recent past, we saw that spate of licenses were given for payments bank and small banks. So my first question would be to Saurabh. Saurabh, don't you find a paradox here? New banking licenses for payment bank, and my question is a little longer, so could be your answer as well. we are talking about consolidation, that's one part of it. But payment bank, do you think they can substitute really the bank? Though Mrs. Iyer said about half an hour back that we may need banking, but not necessarily the banks. All said and done, I think banks will continue to play their role, maybe in a different perspective.
Thank you very much. Good morning, everyone. So clearly, I think we are in one of the most exciting times in banking industry. Indian banking industry, of course, is the spotlight. And I think we are one of the only countries in the world where in a span of 3 months, 20 new banks are introduced into a market. So clearly, disruption is the only word to describe the situation. We will have 11 payment banks, we have 10 small finance banks. Sir, your question is whether they will be able to substitute, especially the payment banks? Of course not. I think by definition, they are not allowed to substitute. And actually, our guidelines actually also say that payment banks can't do lending in partnership with NBFC. They have to lend in partnership with banks only. So clearly, the whole architecture of the setup is such that payment banks have to work really closely with banks to be able to create a full product suite for the customers. But will they really make a difference? I think so. I think through this very proactive regulatory intervention, Reserve Bank has managed to get certain types of players to also participate in banking value chain who were otherwise not willing to participate. You know, they were always being asked to participate. The telecom companies who have got massive presence, large customer base, and an ability to reach people and ability to really have a relationship with people in very large numbers. I think by doing this, we have managed to really get all the major telecom companies to really participate, even though it is not clear that this is a very profitable model. I think everybody knows that. Despite that, we have got all of them to sign up. So it is good for the country. I think it will lead to a new type of services, starting from very technology enabled and in some sense branchless banking to be introduced, and certain segment of customers who are still out of the banking fold will come inside it. And at the same time, I think there will be competition for the digitally savvy customers who are already banked. So in that sense, I think incumbents will be affected. All the payment banks will realize, and I think they do realize that, if they have to be financially sustainable, they have to, reach out to the, high-end customers who are very digitally savvy. In a recent survey that we did of about 3,500 customers, we found two things very startling. One was that half of the digital banking customers of Indian banking industry, half of them who are already banked and already doing digital banking, they said that if the payment banks were to come in, we will try them out. Then we asked those customers who were banking but were not using digital banking. We asked them, will you try payment banks? And only 35% of them said we will try payment banks. So, the existing digitally savvy customer base will be the first one to try what the payment banks will offer. So in that sense, incumbents will face a little bit of heat. So it is not that they will only do partnerships. There will be a heat, there will be a pressure, especially on the savings account business. Even though it may not make a lot of money for payment banks, but it will hurt the incumbents. And I think we are already seeing the good part of it, in the sense that for last 1 year, there has been a lot of effort by our Indian banks, the incumbents, to really prepare for this competition. We have seen a spate of mobile offerings that are being launched, right across last 1 year, and I think we will see that. So I think that was one of the purposes of all of this, was to increase the quality of competition and increase the little bit of pressure on the Indian banking system to innovate. And I think we are starting to see that, and I'm really excited for the next 2-3 years, because we'll see spate of innovative offerings. I think in that sense, there will be a pressure on profitability, and hence the two topics get linked, because when there's pressure on profitability, consolidation will happen. So I think these are two sides of the same coin. Consolidate a set of players who are not innovating fast enough, and hence you will feel the pressure, and introduce fresh blood into the industry to raise the quality of competition. So that's how I see both the things happening simultaneously.
But I have got a supplementary question also there. You said 35% of the respondents said that they will try payment banks.
Yes.
One. Now, any new venture, they would look at the commercial side of it also. Now that prescriptive limit, SLR, if we may say 75% is SLR for them, payment bank. 1 lakh is the maximum they can take. So with that kind of restriction, do you think that they will be profitable, or before they even start off 11 of them, if at all of them start up, there would be consolidation by itself from the word go?
That's a good question. I think payment bank, given the restriction that it has, if you were to just create a plain vanilla business plan of payment bank, it is not very attractive business plan. But despite that, 11 people have got it, and many more had actually applied. They all knew that this is how it is looking. So why are people applying for it? I think people are applying for it because there's an option value. What do I mean by that? Firstly, for the telcos, there is a huge benefit in the sense that once a telco has a customer who has taken up this payment bank offering, that customer will reduce churn. And telcos are, the Airtel or Vodafone, they are very large companies, and even a small reduction in churn is huge value for them. So you can look at it this way, that if you are expecting about 20% ROE on a business, 10% ROE for them just comes by a reduction in churn in the payment business. So the hurdle reduces, and the remaining 10% they have to get, so the hurdle itself is low. Right? So that's one. Second is, yes, you have got SLR and various other constraints, and as I mentioned, there are restrictions on how many partnerships you can do. So, only savings bank account is there really to start with to make money, but we need to recognize, and we will discuss some of this in our panel today, the power of data. They will have data on where the customer is transacting. There was a time when you used to talk about technology and technology strategy. Today, leading companies in the world are talking about data strategy, because everybody recognizes that data is golden. And we are just starting to see it. In next 5 years, the power of data will only increase. Power of data in terms of being able to understand your customers better, being able to make propositions and offers which are right for them, and so on and so forth. So you may be able to monetize the payment information as to where the customers are. So now imagine, even if the customer keeps their term deposit with a conventional bank, but shifts most of the transactions there, even though they keep only 1 lakh rupees in the savings bank balance, but that bank knows all about the customer, the relationship, the depth, the understanding, it shifts there. So it has an option value in terms of what you can do with the information of the customer, and that can be monetized at some point of time, right? That is how the whole e-commerce industry is behaving today, on the belief that data can be monetized at some point of time. So they will monetize this data, and I think for the incumbent banks, I think this is the biggest issue. Why it is a threat? Because if transactions move away, it is not just that cost is moving away. Transactions moving away, the primary relationship moves away, data for the customer moves away, the knowledge about the customer moves away. I think that is the pot of gold on which it is premised.
So, thank you, Rajnish. A hardcore banker. Would you look at these licenses as an opportunity for the banks like State Bank?
I think yes, because what is going to happen, and my take is slightly different on this, that at our branches, with most of the banks, one is that there are a lot of transactions, despite migration to alternate channels, lot of transactions are happening at branches which are low value transactions. And the cost structure of the banking system, particularly public sector banks, because don't have any flexibility. It is a paradox that we have so much labor available in the country, but still, because we have such a rigid wage settlements and this thing, that our costs are high. And what do many of those staff where the costs are high, what do they do? Low value transaction, like accepting cash or transmitting money. These kind of things are done at branches, and that's why the cost of branch banking channel is very high. So ultimately what should happen is that when the payment banks come, and maybe like many banks, and these payment banks, they are already in the talks to partner. So it will provide the last mile connectivity. We have made a lot of effort, particularly I can speak of State Bank of India, where our touch point exceeds 100,000. So we already have customer service points under BC model. We have 22,000 branches, we have 50,000 ATMs, internet banking, mobile banking. So I think public sector banks in the past also have been responding well in investing in all these channels. And one the payment banks, or particularly telcos, who have a very wide reach. So using that as a business correspondent or as your CSP, that can give a lot of advantage in moving away low value transactions to payment banks or alternate channels. And what the role of the branches should become is around value added services, after sales service, wherever customer wants to interact with a branch official in person. Because there are still a large population who loves to come to the branches despite best efforts by the banks to migrate to them. There is a section of the population which is still prefers branch banking, and they are not and cannot think of migrating to the alternate channels. So they need to be served, but more and more value added services need to be given at the branches, so that that is a high cost. And if you give value added services and make it more profitable and move low value transactions to the payment banks and alternate channels. So my view is that it should in fact result into a productivity gain for the existing banks. And that is where the opportunity lies. So partnership and collaboration, I think, rather than competition, would be the way. And payment banks, of course, there is no way in the present format they can substitute the main bankers. And what we have to realize also, if we leave aside the urban or metro space, if in the rural and semi-urban space, the public sector banks are still, they enjoy more trust. People think, we may say that government ownership has always certain negatives, but there is a big positive. Being a public sector bank is the trust of the people. And when it comes to, say, State Bank of India, so people I have experienced in rural and semi, for them, State Bank of India is the only Sarkari bank. So if for a payment bank or anybody, for a small value transactions, they can handle, but when it comes to serious money business, they would still be driven by the trust which has been built over a period of time. So in a way, it is a good development. How much revenue generation potential is there for payment bank? I don't think, and I don't believe it is a very large revenue pool. And when there is so much competition, that revenue pool will come down. So as Saurabh mentions, that for them or for the payment banks to survive, because there is another activity, which is, say, telecom, or if it is a large format retail store where they have a huge database and providing banking services, like in UK, Tesco is the largest departmental store and they were the first to apply for the bank. But in countries like UK or Australia or Canada, banking scene is dominated by very large banks, 6, 7 or 8, and these new banks which are coming up, or alternate service providers, if I call them. So they have to earn their revenue either through data mining or through cross-sell of other products.
Perfect. I'm in absolute agreement with you, because banking is a serious business. And that the trust coefficient is very large. Because we see, as of today also, I think about 60-65% of the branches of the public sector banks especially are in the rural semi-urban areas. You may find an ATM, you may, this depositor may have a debit card, but still he may withdraw money from ATM, but still he'll go inside the branch to that counter clerk, take out his passbook, ask to give that entry, and thereafter also ask to put the rubber stamp and initial it. So I think for payment banks, they are alternates for banking to begin with. And what the two gentlemen said about the predictive data analytics or data analytics, they need to have sufficient history to arrive at that. With that, I will move on to Mr. Yu Chen. You bring in the perspective from Taiwan. The technology part of it. Essentially, whatever paradigm shifts we are talking about in the banking space, this is customer expectation driven, one, and two, the rapid changes in technology. What your thoughts are on?
Thank you, Mr. Chairman. I was recalled last Friday to come here for my presentation. And I prepared several slides. Could I do that? So anybody could help me to? Well, you see, the English is not our native language, so I have the problem to show you all my thoughts. But Taiwan, compared to India, we are only a small place. The Taiwan is only 36,000 square kilometers and 23 million people. Actually, we only have 160,000 bankers in this island. But the IT for us is very important in our industry. So let me, could I stay there? To show you? Okay, this is the outline I prepared for all of you. In our society right now, the shift demand for talents is from traditional banking to digital banking. You see, all our friends here, it's a good dress. That's the symbol of bankers. But in the future, maybe like these young guys, you don't need to wear a good suit. Even in Taiwanese banking society nowadays, the young bankers, they are allowed to wear T-shirts, sports shoes on Friday, the weekend. You know, it shows their banks, well, it's advanced and flexible and more friendly. They are trying to cater for the young generation, you know. So the young bankers, they are ambitious for change. And you know this guy, Brian King, he's an author of digital banking. He wrote 2 books. And he said, the digital is not the department, channel, or separate competencies. It's simply the job of the bank. So we all have to change our mind. He told us the branch is not the physical place. Well, we have to change the role of the branches. Our banking authority, they establish an IT office and encourage all banks to establish IT company. But you know, our old-fashioned banker, they are very solid. If they establish IT company, well, they have a cultural conflict. So they have to hire a new generation to operate such kind of company. You see, every staff works. They have to work as a team, and understand and committing to their new roles to play in the digital age, especially for the old top management. I mean, like a branch manager or the age above 50 or 60s, they are not quite well to use the IT solution. They might be phased out someday. So our authority encourage all generations to learn IT, to understand IT, to explore the IT solutions. You see, the senior executive, they act as a guider, an explorer. And the middle management, they are developers. They are the solution. They have made some good solutions for the for the senior executives. And also the branch manager or the bottom one, the branch, they have to upgrade their knowledge as a professional advisor from the operator to professional advisors. For example, like the senior executives, they have to find the new opportunities. They have to act as an explorer to find different industry strategic partner to solve the problems, and also have to promote change, also to create a good culture of innovation. And the middle management, they are act as a developer. They have to make opportunity become real. Also promote partnership across functions and industries. And the bank themselves, they have many teams, especially work functional team. They have to leverage the power of big data to unveil the customer behavior from emotional, cultural, or social aspects. Especially nowadays, in Taiwan, the Asian people, they are rich. The young people, they outlook, well, they are innovative, but they don't have money. The money is from Asian people. So the functional team has to help the Asian people to, to find the bank is their partner. The brand can say the branch may be disappear someday. But from our point of view, the branch is still there. The branch is still very important, especially for the Asian people. They are rich, they have money. They need branch. They depend on branch manager to solve their problem or to upgrade their knowledge and wealth. So from my point of view, the staff of the branch, they should upgrade to be a good advisor, especially on wealth management area. I'm also the Secretary General of the CFP Association. Nowadays, we encourage those young people to get the certified financial planner, the certificates, and help them to upgrade and to serve the people. And this is the branch operation should have to do in the near future. And especially in the HR area, they should reallocate, we should define the professional competencies at different functions, assess the potentials and gap of knowledge and skills, and also have to develop the training for growth and buy-in and recruit talents from outside of banking. And finally, as our academy, we are offering the brand training with certification to develop and identify high potentials and evaluate the adequacy of talent resource at key position through professional competency assessment. And finally, we know the college education, the IT is IT. And the banking department, they teach the monetary policy, they teach students some derivatives, but they don't have any coursework, they don't have any combination. Our academy acts as such kind of the role to encourage university to conduct several programs for IT person IT students to understand banking, and also teach the student in financial management area to understand IT. And that's easier for all the banking society. When they graduate, they could get a good job and also provide good services for the industry. That's the end of my, my PowerPoint. Thank you so much.
Thank you very much, Mr. Chen. Quite lucid architecture of banking. And I'm sure that TABF back in Taiwan must be doing an excellent job for the banking industry there. Thank you so much. Saurabh, you touched upon the power of data. Historically, the banking space, which is predominantly is taken by public sector banks, are they capturing in first place the data the way it should be? And if they are they in a position to whatever level harness that value of that data? And going forward, when we talk about the data analytics or predictive data analytics, what all do you think? What kind of role it will play in the times to come?
So recently I visited Europe and US on a study trip to just see advanced banks in the world, the case studies that we see all the time and whatever. And I mean, one of the revealing things was that the banks that you may name as the cutting edge banks in the world, they are also struggling with data. Because, you know, the technology is moving at a very fast pace. And organizations, even though they were considered very advanced like 10 years ago, or 5 years ago, they were at the cutting edge. Today they find themselves that they are not really able to get all the data that they want, capture all the right information. You know, 2 or 3 different product lines have 2 or 3 different databases. They don't talk to each other. Problems are the same everywhere in the world. So I would not say that it is a public sector bank issue. Having said that, Mr. Tiwari, I would like to say that, you know, the use of data in banking, and I'm not differentiating between public sector and private sector, I think it is pretty much the same, that we are sitting on the most underutilized asset, right? Because it is not the Google that really has data on the customer, it is the banks who have data on the customer. You know the customer completely inside out. You know where the customer is making the payment to and to whom and for what, right? That type of information nobody else has. And so I think we are just, I mean, now it's starting to be realized by the banks that it is a huge potential. And we are starting to see some action here. Some of the banks that you know, really have taken it to heart and really have taken it to the full potential. I visited a bank called Santander in Spain. So that bank has really taken this data idea to the next level. And there it is actually scary. So they opened up their CRM system to us to see. And they showed us how much they know about each customer. Because you know about each customer's every single payment, you can create psychographic profiling of the type that the bank basically said we don't even tell the customer how much we know about them because they will get scared. So that is the extent. And then today what is happening is not just knowing the customer, we can actually, because you know your mobile application is on the customer's mobile phone, you actually also know where the customer is at any given point of time. So you know then you are talking about context sensitive information, offers, suggestions that you can. So the possibilities are limitless. We are going to see a lot of this coming forward, and I would like to argue that you know banking as such, plain vanilla banking that we have known, will become commoditized. It's a commodity. It's a utility. And so how will banks really maintain their profitability? There's a pressure on profitability everywhere, and the only way to maintain the profitability is to create value-added offerings, to be able to give to customers something which is in form of an advice. Because we have data about you, we can compare you to what other people like you are doing. Customers are used to this concept of people like you. Every time you go to Amazon, or now many other e-commerce players, you know you buy a book and you are immediately told others who bought this book also bought this book, and according to your taste, here are 3 more suggestions. And many people look forward to it. You know, what is this system saying? You know, what are they suggesting? They may not always agree with this. So the expectation is from the banks also the same thing. And we have not yet reached that stage. No bank has reached that stage yet. And it's not very easy to explain why not, but it has not happened. That a bank can say, you know, Mr. Tripathi, there are many people like you are banking with us. They are doing for the following things. You could also consider these. And banks have the trust. So I mean, you know, people are willing to take the advice from the bank. As you know, as you had mentioned some time back, and Mr. Kumar has also mentioned, we have the trust. And so we are best positioned so we have the trust and we have the data, we can convert it to advice and it will be valued. So there's a huge potential there. So that is one side, you know, that you can create customer proposition to engage the customer more, because otherwise what is happening is customers are getting disengaged from banks, you know, over time, especially as they get more and more digital, they do not visit the branch. You know, for them payment is just a activity, actually thing is what you have bought, that's what they're really interested in. Or the loan is just a afterthought, because you know, you really want to buy the car and then you take the loan. You don't engage in the product or loan. But with the data, we can engage the customer, because we can start advising them. We can become real partners to the customers in terms of their well-being, in terms of their financial well-being, and so on and so forth. You know, Mr. Chen's presentation talked about this book, Banking 3.0, right? From Brett King. Brett King is the author, and he referred to that book. And he has created a bank called Movent Bank in US. Movent Bank is a layer on top of traditional banks. So Brett King goes and sells this technology to all the banks. They've sold it to TD, they've sold it to many other banks. And what that does is, that layer on top of traditional banking is just a digital layer, which creates a very customized experience for the customer. And it tells the customer that, you know, just like many people wear a you know, Fitbit on their hands, which reminds them, oh, you have to start walking now, you have to start doing this now, which is a reminder for their health. That Movent Bank reminds them about their financial well-being. You are spending too much. You know, oh, by the way, you have exceeded your spending limit for this month now, you stop spending. And many other suggestions to just make the customer feel that the bank cares for them to save money. That is possible if you use data and digital technology to its full. So I think that is just one of the examples. There are just many more examples of what is possible if the banks were to really use the data fully. I mean, of course, the credit part of it we are not even talking about. I mean, there's a huge potential there to be able to use data to do credit better. Now, Alibaba Financial Services is lending to customers completely unsecured, but based on their transaction history, and their NPA levels are 1/10 of what the banks are able to do, just because of the power of data. So I think we can go on and on. I think the next big thing is data, really. And then technology is just there to support the usage of data. And of course, you rightly pointed out, you know, we will never be able to capture everything we want to capture, but whatever we have captured already, are we using it? I don't think so. So I think that's where we have to start. Then more and more avenues to capture more data will come.
Rajnish, your bank, State Bank, you had started off with InTouch, that was a digital platform. How has been the experience, one? And going forward, what role do you think that social media will play in the banking space?
InTouch, I think it has been a very good experience for our customers, and it's a novelty, I would say. And hereafter, what we are doing is that majority of our branches in urban and metro areas, they are coming in InTouch format. In rural, semi-urban, we are yet to move, but I think that is the way forward. And the branch banking space, I said that it is going to change, and you have to keep customer profile in mind, where when you are designing a branch, you have to keep in mind that what kind of customers are coming there. So it will be very popular with the young people, and that was the whole idea. And social media space, again, as the State Bank of India, we have been very active, and there is again a lot of behavioral patterns which can be captured through social media, and they can play a critical role, as Saurabh was mentioning, in assessing the needs of the customer real time based on their, and even your credit decisions and financial advisory decisions. Critical inputs can come through social media and the behavioral pattern of the people who are active on social media.
But ultimately, when we talk about the technology piece in the service industry like banking, we are talking about cost effectiveness and ease of doing that transaction from customer's point of view. When we talk about the consolidation, Saurabh or Rajnish, why can't, before we go into the consolidation of the banks, like some of these back-end technology platforms, why can't they be consolidated? Like if 2 banks or 3 banks or 4 banks are running on the same platform, whether it's of Infosys or TCS, so all these back facilities, why they can't be pooled or consolidated? Do you think going forward that should be looked into?
There are models where like, say for example, mortgages. So there are companies across the globe where they provide shared services, what we call the shared services. And you can just it is pay per use. So that is happening, and in UK I have observed that there are very established players at the banks. They don't have to build their mortgage platform, they outsource it. The issue which comes is all about like banking and the data privacy and secrecy laws, and in India still the laws are not very, stringent. But in the entire Western world, the laws around data secrecy and protection are very, very stringent, and the database of the customer, which is sensitive and confidential, that has to sit in the bank and protect it. So I think as far as core banking is concerned, it may be very, very difficult for banks to outsource that service. That has to sit within the bank. But supplementary services, like as I said about like running the internet banking applications or some of the mortgage applications or loan collection, loan servicing, if the systems of the service provider is very strong, so that can be a very productive and effective model. And many products are available off the shelf where you don't have to invest too much money or time, like say for example, for customer relationship management, even Microsoft has, I'm just giving one example, they have a ready platform. So this is a debate, I think, which keeps on happening, and I'm sure it is happening in all the banks, that how much to keep within and how much to outsource. So because security considerations are there, confidentiality clauses are there. So if you decide to outsource as a bank and share and use shared platform, one has to be very, very careful about the robustness of the entire system, and there should not be any data leakage or any compromise on the security aspects. And but it is a feasible model. But if we are talking about like the banks in India, and most of the banks, they are, say for example, on Finacle, or we are on Bank One, which is run by TCS. So the service provider is same, but still again, there is a lot of customization which happens. So I don't think that you can just create a clone of each other. But if we are thinking of any consolidation, then the commonality of platform would be a key consideration, but that will not be a sort of deal breaker. That's what I feel. And we had studied the entire banking system at SBI CAPS, and integration of technology was one of the factors, but ultimate conclusion was that that is not going to be the deal breaker. If any banks wants to consolidate, then the technology can be consolidated and migration can happen, but it is always a painful process that everybody is aware. And any consolidation or merger, if there is a gain, but there is a lot of pain also around that.
Yes, I think this, I agree with Mr. Kumar. I think the consolidation in Indian banking industry has been talked about for last 15 years, and we have not moved because the underlying economic logic is not very clear. If you really ask, should there be consolidation in Indian public sector banks, you can't really argue, because each one of them, even the smallest bank is not subscale. There are much smaller banks which are very profitable. So it is not that by merging two public sector banks, we make them profitable. I think that argument is more driven by considerations of HR and talent than really about fundamental economics of banking. And I think this is not, issue is not debated with proper openness as to why we are doing it. So, and hence I think it doesn't move. So they keep saying board should come to us, and board will not find any reason, logic to do it, right? So technology, I mean, banks across the whole world merge, and they often have different technology platforms, and technology is, we are able to take care of it, yeah. And in India particularly, and I found it like for last 5 years, every year we do this private research, the cost of technology in India is 1/5 to 1/10 of cost of technology for the bank in the world. So in India, banks spend 2%, 3%, maximum 4% of their revenues on technology. The banks in the West will be spending like 15%. Even the most technology advanced banks in India will have, about 1/4 of the number of people that the comparative banks in the other parts of the world will have. So technology is very unique thing in India in terms of agility and the low cost in which we are able to operate. So definitely, while, I mean, I don't want to take away from the point, there could be a lot of benefit by some people sharing technology, and there is we believe that the software as a service, which is a cloud-based service for banking, even though there is a lot of resistance now, but it is going. And I think it is just a matter of time. In the next few years, we will see that cloud-based software will be used for many applications in banking. So it is going to happen because the concerns of security and technology is advancing, and some of these things are going, and that will reduce the cost quite dramatically. So that is going to happen. But I'm seeing another very interesting trend. All the banks that I meet in the West, they are insourcing technology more and more, because they are finding that technology is their unique competitive advantage. They are feeling that if I buy a mobile banking application from a vendor and my competitor has also bought it and somebody else has bought it, they all look the same. So the new trend is that the lower standardized, what is called technology stack, the core banking platform and some of the other softwares which are very core, they are, one could think of a way to outsource it. But the applications which are customer facing and the applications which are employee facing, on which the customer operates, on which the employee operates, you better keep them in-house, because that is where the source of competitive advantage is. Right? So I would like to have my own mobile wallet and how it is made, and I would like to have the agility to change it as I learn more and more things, and not wait for the vendor from whom I purchase it to really change it. So we are going through this very interesting change today in banking technology, and many of these banks are creating innovation centers where they create an environment where best technology people would like to come. So there is a bank called, ING Bank in Netherlands has basically taken upon a challenge that IT talent coming out of the schools, they should be as attractive for them to work for them as it is to go to Google. Now, in order to really create that attraction, they have to create an environment. So they have to create a unit which is a little bit outside the bank's architecture. Their culture is different, their HR policies are different, so that talent, which is the new talent actually, which was there in Mr. Chen's presentation, the new talent wants to work in a slightly flat, less hierarchical organization, and so on and so forth. So I see repeatedly bank after bank trying to create a core team of technology people who can be the source of their differentiation.
Mr. Chen, can I have a small question for you? Back in Taiwan, to what extent the technology is playing a role in delivering banking services, especially in the smaller towns? Yes.
We have more than 30 private banks in the small island. That means it's overbanking in our industry. So the government try to encourage, there will be a consolidation among banks, but most of the chairmen say no. They want to be the chairman. That's a democratic society. They want to be the head, not the tail. So it's very hard for us to do that. So our government, 40 years ago, we made a very good solution for those banks. We established a so-called credit information center. What it means, the customer come to my bank to apply for a loan of 1 million, and to your bank for 1 million, to your bank for 1 million again, and we don't know each other. I mean, if the customer is a criminal, it's very hard for us to find out among us. So the government established a so-called Credit Information Center. Any banks, if they accept the loan from the customer, they should report to that information center. And every banks, they are all the member of the information center. They all know, among of us, to know that customer, how much they try to, apply for loans among our banks. So that for us, that means that the old banks, they don't have much risk among banks. They all know these bank customers. If they default their loans, they should report to the information center too. So this credit information center become very famous in the world. And you see the digital world, we face the same problem. The small banks, they don't have much money to invest. You see that like a nuclear war, The only the big country could play the weapon contest, but for the small banks, there's nothing to do. So the government, they established a company for the total solution for the small banks. For example, like an ATM. They established an ATM solution center. That means that credit union or farmers association, the small union, they still have chance to use the technology among all the association or the unions. I mean, the farmers association is relatively small, especially in the rural area. But they have a very good IT solution for the customer because we have a centralized information center, information company to provide the IT service for the small credit union. This is our solution right now.
Rajnish, we left that question halfway through consolidation. Right from Gyan Sangam to Indradhanush, government is talking about what Saurabh said for the last 15-20 years of consolidation. If consolidation ever, what I can see in the public sector space, one was that New Bank of India and Punjab National Bank, and another was one of the associates of State Bank of India was merged with State Bank of India. And government at the same time also says that it should come from the bank. Why we should impose it? But then consolidation for what? Size? Does it matter? Or the efficiency? So going forward, next 5 years, do you think that there would be consolidation on the bank? Whereas on the other side, we are having, like last 2-3 months, about 20 odd banks have been given licenses, payment banks and small banks.
Right. So if we are talking about the public sector space, all the consolidations or mergers in the past have happened at the instance of Reserve Bank of India, when it was realized that an entity is going to fail, like New Bank of India, and the only way out is to hand it over to some bank. Or GTB, which was a private bank, but being given to Oriental Bank of Commerce, and in State Bank of India, I am unable to count how many banks have been handed over to us in the past. But last 10 years, I don't think anything. The last one was Kashinath State Bank in UB, which was handed over to State Bank of India. Mr. Tyrone made a very important point. That one is that everybody wants to be chairman. So which is the biggest roadblock if a consolidation has to happen in public sector bank? And Saurabh made a very important point is about why. Why should we merge? Unless we are very clear on that question, the mergers cannot happen. So definitely I feel there is a need, though we are having small banks like payment banks or small finance banks. But what we find today is that after State Bank of India, the next bank, it is 1/4 of its size. And when it comes to large accounts or corporate banking, this causes a lot of problem. Because the need of the corporates are growing and they are very large, but the capability of the banking system to meet their needs is very, very limited. So if the question is that we need a couple of more strong banks, then merging a weak bank with a strong bank is not the answer. Merging a weak bank with a strong bank is only when, as I said, that if Reserve Bank of India tomorrow feels that this bank is not going to survive on its own, so there is no option but hand it over to some other bank. Now, if, I don't know, but if ESOP comes, and where then it can be a economic consideration that by merger, whether the value of the shares of the combined entity, it is going to go up, and it would be in the interest and benefit of both the entities, then probability some of the bank chairman may still feel, okay, I may not be the chairman, but I'm going to get a more value out of it and let us merge. But that's a very theoretical construct, and I feel that for mergers to happen in India, unless it is a nudge from the government and government forces, it is not going to happen voluntarily.
One thing which has been in vogue for quite some time, capital or Basel III. Now when we talk about the Basel III, it was triggered after that whatever happened in the United States of 2008 and the United States of USA. Now when the prescription is in place, the great sovereign USA says it would be only for those few international active banks, not those 6, 7, 8,000 banks across the board within the national boundaries of USA. Whereas in context of countries like us, some days back I was in Singapore, so one of this investor asked me, Mr. Tiwari, could you please tell me, and I'm sorry to use that word what he used for our regulator, why your regulator has so draconian prescriptions, whether it's rollout of Basel III, they always fast forward then normalize it, and so also about the risk weights. And he gave the example, very clear example of mortgage loans. Globally, you will never find 100% or 125% risk weights. It's 20, 30%, 35% at the best. And even that is, whether we, that CRAR Tier 1, specifically, saving and accepting Singapore, we are ahead of all of this. So, capital is needed. Capital, even laymen of the world had great capital with them, but they still failed. So, capital to what extent and capital at what cost? Saurabh.
So I have to defend RBI. It is true, I think that your observation is completely right, that RBI always adds a layer of conservatism on top of everything that is internationally agreed. And, but I think they have got emboldened or encouraged by the fact that the conservative stance has always helped. And the global banking crisis and all that stuff, you know, we were very conservative and we stood out quite nicely where the whole world had a big problem. So I think if you were to talk to RBI, they would say, look, you know, that that stance has always held. But there is one more thing that is also true. You know, developing economies like India are inherently more risky. And so they require higher capital cushion. I think that at a philosophy level is important to note. Why I'm saying this is because all this crisis that we are noticing today in India about bad debt crisis and all that, and people tend to find a simple answer to say, oh, bank systems to evaluate risk is poor. I think that is really very superficial argument. The real argument is India is a large country, a democratic country, is trying to go out of poverty into middle income and then high income. That journey of high economic growth with democracy, with so many pushes and pulls, with independent institutions, like Supreme Court having its own view and government, it creates a lot of volatility in business environment. That creates risk. That risk just panned out, and our banking system had to bear the brunt for it. We have to recognize that in a rapidly growing democratic environment with multiple pushes and pulls and multiple vested interests, it is an inherently highly volatile situation, and hence the risks will always be high. So on the margin, I understand it hurts the bankers and it puts a lot of pressure on you, but I think from an RBI perspective, there is a philosophical argument to say if our banking system has a slightly higher cushion, given that we are on this roller coaster, it is good for the nation and it makes prudent sense.
Would you like me to comment? Okay. So, I think what we have to analyze is, one is that till 92, it has always been a very, very regulated banking sector, and where Reserve Bank of India was in command in telling what to do, what not to do. Even you would remember, Mr. Tiwari, that for a 1 crore loan, we had to go to Reserve Bank of India under credit authorization scheme. Interest rates were all administered. There was no competition practically in the market. So there did not happen any innovation or the systems which should have developed in terms of superior risk management. So they did not that. It is Indian psyche. I think parents know all. So I think same thing was with Reserve Bank of India. And it is a chicken and egg situation. Whether you believe in your progeny, allow them to learn through trial and error, or just believe we know it all and we just tell you what to do, what to do, what to do. But the negative side is it never allows innovation to happen. And that's why when you see the innovation which has happened in the Western world, we may say that, Levan, and we can take pride that we were not affected by that because we had very strong. But we have to realize that in terms of innovation, where are we today in banking system and where are the other people? So when you have a very prescriptive regime and a very protected environment, so positive is that the kind of shocks which happen may not happen. The negative side is that it stifles innovation. The tendency for the banks also would be that what does Reserve Bank of India say? And we would always be looking towards Reserve Bank of India, what their rules is, rather than developing a system and a culture which takes into account the risks which we are handling. And I think now, almost after 25 years of reforms in the banking system, we are in the stage where we are now saying that let us have our own risk framework, let us define our risk appetite and work according to a plan. So I think as far as India is concerned, that is going to remain RBI's role in terms of this thing, because even when it comes to asset classification or provisioning, in India we just go by a 90-day. But the fact of the matter is that in any advanced economy, the asset classification does not necessarily depend on 90-day payment rule, and if there is, immediately when they recognize that there is an inherent weakness in the account, any loan account, and it will be provided for. The income streams are high, and at the same time that enables the banks to be aggressive on provisioning. In India, the incomes are under provision, so the ability of the banks to provide for the loans, and as Saurabh mentioned, we are a developing economy, and it is not that the bankers and public sector bankers, as is made out in media, that they don't know their job. So that is not a very correct interpretation. It is macroeconomics which has affected a lot the quality of assets in the bank, and of course I'm not saying that we are perfect and there is no scope for improvement as far as our underwriting practices are concerned. They need to be improved, no doubt about it. And the role of capital as a buffer, but if the, I think it can play only a limited role according to me, and in 2008 of course it came out very clearly that capital itself is not sufficient, and it was more to do with liquidity, how the assets were being funded, as we saw in the case of Northern Rock in UK. So they had a very stable portfolio of the mortgages, but all funded by the wholesale bank funding, and when the crisis came in, they collapsed. So there then realization came about the liquidity ratio, net stable funding ratio, and all these new ratios have been prescribed. So do we need to be fully compliant as far as Basel III is concerned, or are we going more than this thing? So I think the certain inherent weaknesses in the risk management practices and management of loan assets, so that I'm sure even that must be weighing in the minds of Reserve Bank of India when they make what you heard about is the draconian laws.
But still, the prescription of regulator, we have SLR of 21.5%, and still we talk about LCR.
Yeah, I think
that is one. And two, I mean, the contradiction I'm just referring to. But in as much as the Basel III compliances are required, the kind of capital we need over a period of time, we all know that banking is, I think, perhaps one of the highest leverage industry. Look at our capital and our liabilities. Nonetheless, whatever capital is required, government has its limitation, though the fiscal numbers are slightly better than before. Do you think that in next 5 years, because having infused, I mean, promised to infuse that much amount, 25,000 crores this year, and then going forward next 3 years, that would not be adequate? What government's stance is that we would be able to raise capital from the market. Do you think once the economy picks up and the kind of money would be needed correspondingly in our capital, would we be able to generate that?
It's going to be like very difficult again, because the focus so far of public sector banks has been always on the top line growth. But now we are talking about this new paradigm, and the focus from top line growth must go, and the focus must go on risk adjusted return on capital. But as you mentioned that bankers or banking make money by taking risk, and leveraging was one of them. So as you deleverage the balance sheet, right, and more stringent requirements under capital adequacy framework comes, the return on the capital is not the same as is used to. So again, coming to the back to like what is the return on capital for most of the bank internationally is now 6, 7 or 8%. And if that is the case, then who will put the capital from the market if the return on capital? So we are in a catch-22 situation. So for the banks in India, particularly public sector banks, finding capital to meet the requirement is going to be difficult. Government this year, because of the fall in commodity prices and particularly oil and energy prices, there was headroom available and they were able to provide the capital. But going forward, will that always be the case? I think it is very difficult to predict. And raising capital from the market cannot happen unless the profitability improves. And profitability cannot improve unless the asset quality improves and the what we call the credit cost or provisioning costs come down. Right now, the return on assets is for most of the public sector banks is around 50 basis points, and return on equity would be not more than 9 or 10%. So in such a situation, going to the market and asking anybody to invest in bank's capital, so who is going to invest at such low rate of return? So that means that the task for all the banks is cut. They need to look at each and every activity from the perspective of risk-adjusted return on capital. We cannot just blindly follow each other and just be focused on growing the balance sheet. Each and every account you have to map and see whether it is meeting my at least average cost of capital. So my risk-adjusted return on capital has to be equal or more than that. But as of now, that is not the situation. It is a concept which is in the developing stage, and maybe over a period of time when you don't have any choice. Pillar 1, or what we call, it is all numerical exercise, quantitative exercise. So either you adjust the numerator or denominator. One has to be adjusted, either find the capital for growth or deleverage and have the balance sheet size or risk-weighted assets as per availability of capital. And your question on LCR, I think they are considering that there is a huge SLR requirement which is unique to India. There nowhere in the world it is so high. So I personally believe that LCR was not necessary in this country. So now we have 28% investment SLR and LCR plus priority sector lending plus regulated interest in agriculture sector. So what is left for me is just 30% or 25% on which I have to earn to give a decent return to the investor. So our hands are all tied to the back and still we are trying to save. But I think that is the ground reality. We have to live with it.
I think just adding on to the points that Mr. Kumar said, will public sector banks have any dearth of capital? I think the answer was yesterday when the FM gave a hint that IDBI may go down the Axis Bank route and see what happened to their share price. See, if the government gives real sincere signals about real autonomy, the valuations will improve and you will not have any problem. I think the whole problem is about the fact that market does not believe. Whatever you may call it, Indradhanush, you could call it Gyan Sangam, whatever, the market does not believe that the government really, sincerely will give autonomy. And autonomy is autonomy about HR. I think the real issue is talent. If they somehow can disconnect themselves and let the bank be professionally managed from the perspective of not just the board, but also how the HR policies are there in the entire system. I think that is when we will stop having the worry about capital. Until that time, the government is not willing to really bite the full bullet. I think we will have these perennial worries.
I can't be more agreeing. This all the large organizations are run by the people, and when you don't have the autonomy, I mean, one classic example is IIBF, which is institute created by the public sector banks. We can't hire from there. Anyway, Mr. Chen, how well capitalized the Taiwanese banks are? They are adequately capitalized, or no? There is also a problem of capital adequacy in most of the banks.
Well, most of banks, well, they face a very severe competition. Our spread rate is only 1.5%. That's very low. So the bank themselves very hard to get the funds on the capital market. They have to issue the corporate bonds or find some good from the stockholder, etc. But nowadays, like most of the country, the government encourage they could merge together. Nowadays, they have several banks that have already merged, but they still have a long way to go. This is the problem, in our banking industry.
Thank you. One last thing which has been a pain point for last few years is the stressed portfolio of assets. The way it was done, you have a larger exposure to what is happening in the different countries. What they did in China was they pooled all the bad assets in one bad bank. It was capitalized by the government. Immediately thereafter, all these top 4 banks went for the listing, and at Hong Kong and New York Stock Exchange, whatever surplus money they got as the premium, that was returned to the government. So it was revenue neutral to the government. Can we think of something like that, or close to that, in our perspective?
I think there is discussion on that the government is talking about creating a vehicle, and I think we have precedent in India also. I think that's exactly what was done for UTI, and it paid rich dividends to the government. But I think there is one line of thinking which is against this idea, and that line of thinking is that it creates moral hazard. That an institution does something, and the people are there and everything, and then when things go bad, you just take it out, and then things are good again. So I think there is an orthodox thinking that, I mean, unless it is a crisis, which I don't think it is in our case. It's not really a crisis. It's a very painful situation, but it's not a crisis where, at UTI they had to do it because it became a public issue. And in our banking industry, it is not a public issue. If it was a privatized public industry, it would have been a public issue by now, because people would have started running to take the deposits out of the banks. But in India, nobody wants to take deposits out of the bank, because they know that whatever happens, even if their NPs are 20%, the money is safe. So I think the issue is not really that big from that perspective. So I think there is an orthodox thinking to say, look, let it be sorted out within the institution, so that there is at least some institutional learning, some deterrence to, or some pressure to see where is the room for improvement, so that at least some part of it doesn't happen again. I think large part of it is macroeconomics driven. We firmly believe it. You can't avoid it, but there is certain improvement possible in our systems that people should really go through the whole thing. And so I think that is one orthodox line of thinking which probably will prevent this idea to be adopted as the only idea to solve this. My view is that I think we will do it. We will create a bad bank. Only part of the assets will move there, not a large amount. So it will create some relief, and some of the things will stay in the bank books, and individually bank will have to resolve it. I think that is, if I have to take a bet on what will happen, that's where we seem to be heading. But I think government just takes about a year to really reach from some new idea to taking it to some level of completeness, which is what they did with our selection process of this time. So it took like almost 1 year to do it. So I won't be surprised if it takes a year and a half to get there. And hopefully by that time the economy should improve, so the need for it should be a little less.
Rajnish, you have headed SBI caps.
Yeah.
So I'll have a different, from the same context, I'll have another question. Like, by and large, if that bad portfolio or stress portfolio, 55 to 60% is the stalled projects. Now you talk about the stalled projects, roads, ports, steel plants, power plants. The gas was promised, not given. Right of way, not given. I have seen a few of the cases where it's a road project, 80% is done, that 2 kilometers, and it was 2 lanes to 4 lane. The state government says, no, this corridor, this is 2 kilometers is an elephant corridor, so you have put a flyover or bridge. Now, whom to blame? That is one. Resolution when it comes to, for again, the more pain is for the public sector banks, you have to follow that process. And it will take its own time. Talking about ARCs, you may sell it to them. Now they have started giving 15%, but the resolution, I have not seen any resolution so far in last 2 years. So you keep paying 1.5% management fee every year, and at the end of 5 years, you will pay out whatever they had given to you, and we are at square one. So do you feel that going forward in a year or two, there could be a brighter side for the resolution?
I hope so, because now a lot of hopes of the banking industry are pinned on the new bankruptcy law which is being talked about, and which is likely to be tabled in the parliament in the coming session. So creating a bad bank or like a bank for taking this thing, unless you have a proper recovery and resolution mechanism, so how is that going to help? I also have my reservations about it. So definitely, like what happened that when the sectors were opened in infrastructure, particularly power and roads, there was no option, but public sector banks had to support. All the DFIs, they had disappeared from the scene and all became universal banks. So in that scenario, I think banks saw opportunity also. It's not that it was not seen as an opportunity. And even if we look at the pricing and interest rate and all that, so compared to other loans, there was definitely a better margins, better upfront fee. So when all these loans were done, it was with the expectation of better returns. But yes, many projects run into difficulty because of the environmental issues, as you mentioned, or encroachments or this thing. But the biggest problem came in the power sector. And core industries we have always been financing, whether it is steel or this thing. So they have always been cyclical industry. Unfortunately, this time bad cycle has been much more prolonged. But steel industry, we did restructuring in 2001, and then there was a good time and they came out of it and everybody made money. And in the power sector, the problem is mostly now, as of now, I see is around the reforms of the DISCOM. Fuel availability, even on the gas front, there has been improvement, and government has auctioned, and luckily, as of now, because the international energy prices are down, so the cost of the gas also has come down, and government has given support and tried to see that the tariffs of the gas-based plant, they come almost at par or maybe 20-30% higher than the traditional thermal power sector. So if the power sector reforms are to happen, and if the government and the state governments, they are able to tackle DISCOMs, that will be a big positive for the power sector. And the projects are all, I believe, they are good projects. Many of them which were started in 2010-11, they have now been commissioned, and they have started supplying power. But PPA is a problem, and PPA is a problem because the DISCOMs don't have money. DISCOMs don't have money because the what we call transmission and the distribution losses are very high. But if we look at the demand, I come from the state of Uttar Pradesh. If people get power for 10 hours, they consider themselves to be very lucky. And that is the situation in many other states. So for power sector, the key lies in the DISCOM reforms, and I am sure, and in last 3 years, there are no new projects announced as far as thermal sector is concerned. So going forward in 2-3 years time, maybe we are in a situation where the power prices will go up, because if today we conceive any project, it cannot be commissioned before 22 or 23. So whatever were all these projects which are in private sector, they all were conceived in 2008-9. Projects got off the ground in 2011, and now in 4-5 years they are coming this thing. And renewable energy, yes, there is some action there. But again, the contribution of, even if we put presuming that 1 lakh megawatt in solar, so that translates to just 20,000 megawatt. So that is not going to make a big dent. So ultimately, I am more positive on the power sector, but we have to hold out for another maybe 1 or 2 years. So the key lies in power sector reforms and the faster recovery and resolution, where like effective bankruptcy law and the working of the debt recovery tribunals. And I don't know, but courts also, they need to intervene less in these matters. And in UK, a mortgage can be enforced within 15 minutes. I'm talking about the decision. Court doesn't look into anything. They just look into whether the disclosures were proper or not, whether the customers, but if they are mortgaged and the disclosures are proper, you get a possession order, repossession order in 15 minutes, and after that sheriff moves in, and in 35 days. So from the start of the process, within 60 days, the mortgage property is in the hand of the lenders, and another 1 or 2 months. So I think the total cycle does not go beyond 120 days. Here, enforcing a mortgage and your rights under SARFAESI, they itself takes forever. So I think not only bankruptcy law, but the functioning of DRT is very, very crucial, and plus coupled with the fact that at banks we need to improve our due diligence processes, and lot of improvements in terms of pre-sanction and post-sanction supervision monitoring is required.